lot of people aren't going to notice $10 a month extra in their paycheck. They just won't notice it. So they get to the end of the year and they hear for 2018, oh, my tax return is going to be simple. I can send it in on a postcard and my taxes are going to be less. That's what they hear. And in 2017, they got a $500 refund, but in 2018, they get a $400 refund. That's all they pay attention to. How much is my refund? And they're going to say, the majority of them, not all of them, how could the taxes go down when I only got $400 back this year and I got $500 back last year? They don't understand it.
In January, the federal government passed the first major tax overhaul since 1986. The bill cuts taxes for corporations permanently and for individuals temporarily. Pete Walker, a local accountant, said individuals who see more money in their paychecks ought to be prepared for potentially smaller tax returns in 2018, even though they may be paying lower taxes overall.
The taxes they take out of your paycheck are just an estimate of what your taxes for the year might be. So then you get to the end of the year, January, February, and you actually do your tax return. We do a calculation. This is your actual tax. Now we compare that actual tax to what you've already got paid in. When they adjust your withholdings, you now have less paid in. If your actual tax went down $100, but what you actually paid in went down $200 because they adjusted it, you're going to end up owing $100 more at the end of the year, or having $100 less refund. People don't understand that. If you're getting a refund, that merely means you paid too much tax in. Well, let's make it $1,200. Your tax used to be $1,200 a year, and now because of the new tax law, it's $1,100. And you used to have $110 a month taken out, so you'd have $1,300 paid in, but now they adjust your withholdings, so now you're only getting $70 a month paid in. 70 times 12, you're going to have $840 paid in. Your tax went down from $1,200 to $1,100. You used to have $1,300 paid in, your tax was $1,200, you get a $100 refund. Now your tax is $1,100, but you only have $780 paid in, you owe $400 or $300. The withholding tables don't accurately reflect what's actually going on the tax return itself. And then they never have. Not just in this tax law change, they never have.
The bill is a major cut to the corporate tax rate, bringing it from 39% to 21%. Walker said provisions for small businesses may have an equalizing effect on the overall tax benefits.
There is a new section of the code called qualified business income, and business people are now permitted a new deduction under some circumstances. And my feeling is that they have done this for small businesses because they've substantially modified corporate income tax. Corporate income tax has been reduced substantially, and I think they were trying to be fair to some extent. And if a corporate business has its taxes reduced, why shouldn't other businesses also have less tax burden? So they've come up with this new deduction, qualified business income, and a percentage of that is deductible to try to equalize that a little bit.
Walker said taxation on small business is easily visible and sympathetic, but large businesses often account for a greater amount of regional employment.
The majority of people in this country, taxpayers, are employees. And so you want to do something that has big impact, you do it for employees. There's a lot of big corporations. You want to have a big impact, you do it for big corporations. It's a little tougher, frankly, to do it for small businesses. and there, you just don't have as big a splash when you do something for small businesses.
The theory that cutting taxes for big businesses stimulates economic growth, commonly referred to as trickle-down economics, is often debated, as other local accountants have previously explained.
Adjustments or reductions to corporate income tax rates, the argument has always been that okay, if you're profitable and there's a certain amount of your income that's going to pay taxes, if you reduce that, then you have more income left inside your business that you can reinvest. You can hire more people, you can buy more equipment, you can increase your inventory, you can carry more accounts receivable, all those things. In theory, yeah, that makes a whole lot of sense. Again, I think the issue becomes to what degree does that happen, and what exponential growth is there because of that. I mean, certainly you can look at some people that if there are some businesses that, yeah, if they have more, they will invest it. They need to invest it. Maybe it means less debt for that business because they've got more income retained in the business that hadn't been paid out in taxes. But you also look at that and say, are they just going to pay it out to the owners of the business as additional compensation or as dividends? Then you take it a step further. Well, what do those people do with that money if and when they get it? Big picture, I think the assumption would be, certainly from a global perspective, yeah, it would be expected that it would. There's just more revenue out there churning through the economy.